Imagine there's this engine kind of humming quietly beneath the whole stock market, yeah? And it runs on borrowed money. Now, this engine, it can seriously power up your gains, amplify them, but it's also got this potential, this power to unleash some really destructive forces.
Absolutely. Destructive is the right word sometimes.
And it leaves you wondering, just how much borrowing, how much leverage is really propping up the market right now?
That's the $1 million question, isn't it? Or maybe $1 trillion. And that engine, that borrowing, it's leverage. It's absolutely fundamental to how markets work.
Right.
And like you said, it cuts both ways. Big potential wins, sure, but also, maybe more importantly, really big potential losses. Understanding this stuff isn't just, good to know. It's essential if you're going to be in the market.
Totally essential. And that hidden engine, that's exactly what we're digging into today.
Okay.
This deep dive is all about margin trading, specifically in the U.S. stock market.
Yeah.
Basically, it's borrowing money from your broker to buy stocks or other securities.
Right.
And the stocks you buy, they act as the collateral for that loan. Simple concept, really. It lets you control more stock than just the cash you've got sitting there.
Yeah, that's the cash market side, spot on. But it's worth remembering the idea of margin isn't just for buying stocks. It's also key in trading derivatives, think futures, options, that kind of thing.
Ah, right. Different mechanism.
Slightly different function, yeah. For derivatives, the margin you put down, that initial deposit, it's less like a down payment on a loan and more like a performance bond or collateral.
Okay.
Its main job is to make sure you can cover your potential losses if the trade moves against you. So the underlying economics are a bit different from borrowing to buy stock, but the theme's similar. You put down a smaller amount to control a larger potential value.
Got it. So what's our plan for this deep dive then? We've got some interesting sources lined up. There's a really detailed risk disclosure from a major broker. Honestly, it's eye-opening stuff.
Those disclosures are always worth reading carefully.
Definitely. And we also have this analysis piece that looks back at the whole history of margin rules in the U.S. It talks about market integrity and, crucially, gets into this long-running argument about whether margin rules actually do anything to control market volatility, especially since the '87 crash.
Ah, yes, the volatility debate. That's a big one.
Huge. So our goal here is to really unpack all of this for you.
Yeah.
We want you to walk away understanding, like crystal clear, the real risks you take on with margin trading, and they can be serious. We'll look at why these regulations were created in the first place, their history, their stated goals.
Including that volatility goal.
Exactly. And then what does the actual research, the studies done over decades, tell us about whether margin rules actually work the way they were maybe intended to in terms of taming market swings. So let's maybe start with those risks. They seem fundamental.
Okay, sounds good. Let's get into the mechanics and, more importantly, the dangers. Like you said, margin trading means you buy stocks, partly with your money, partly with money borrowed from your broker. And those securities you buy, they sit in your margin account, and they are the collateral for the loan. It's a bit like taking out a mortgage on a house, right?
Yeah.
The house itself secures the bank's loan.
Okay, makes sense.
But here's the kicker. In the stock market, the value of that collateral, your stocks, can change incredibly fast, way faster than house prices usually move.
And that speed, that volatility in the collateral's value, that's where the risks just balloon, right?
Precisely.
The disclosure doc we looked at, it lays them out so clearly. Everyone thinking about margin needs to see this. Risk number one, and maybe the most jarring for people, you can lose way more money than you initially deposited in the account.
This is leverage 101, but working in reverse. When the stocks you bought with borrowed money go down in price, the value of the collateral backing the loan goes down too.
Right.
Brokers aren't just going to sit there and watch their loan become unsecured. They have rules. There's a minimum level of equity, your money, relative to the total value that you have to maintain in the account. That's called the maintenance margin.
And if you drop below that,
if your equity falls below that maintenance level, boom, you get what's called a margin call. It's basically the broker saying, hey, you need to deposit more cash or more securities right now to bring your equity back up.
or else?
Or else they start selling your stuff. And if you can't meet that call, or sometimes even if they don't give you a chance to meet it, they have the contractual right to forcibly sell your positions to cover the loan.
And this is where the losing more than you deposited part comes in, I guess.
Exactly. If the market's falling hard, the money they get from selling your stocks might not even be enough to pay back the loan amount plus all the interest you owe.
Ouch.
And guess who's on the hook for the difference? You are. The customer is absolutely liable for any shortfall, any debt still owed to the broker after they've liquidated your assets. So yeah, your losses aren't capped at your initial investment. They can go much, much higher.
Okay, that's stark. Which leads right into risk number 2 you mentioned.
Oh.
These forced sales.
Right. It's the direct consequence of falling below that maintenance margin level. Now, there are regulatory minimums. FINRA sets some basic levels, like currently 25% equity for most stocks. But, and this is important, your broker almost certainly has their own higher requirement. They call it the house requirement.
And if you drop below either of those,
If your equity dips below the maintenance level, usually the broker's higher house level, the margin agreement you signed gives them the explicit right to start selling. And listen to this. They can sell not just the stocks in your margin account, but potentially any other assets you hold in any account at that same firm.
wait, any account, like even my IRA or a separate cash account.
If it's held at the same brokerage firm, yes. The standard agreements are written very broadly to protect the broker. They can liquidate assets across your accounts to cover a deficiency in one margin account. It's designed to ensure they get their money back.
Wow, that's broader than I think most people realize.
Yeah.
Okay, so forced sales of potentially anything. Then risk number 3 you flagged is also kind of shocking. The broker can sell your stuff without even calling you first.
This is a huge misconception. People think, oh, I'll get a margin call, I'll have, a day or two to deposit funds. Maybe sometimes you do, but you absolutely cannot count on it.
The disclosure we read from Interactive Brokers was explicit.
Super explicit. It basically said, we generally will not issue margin calls. We can liquidate your positions immediately and without prior notice. Now, maybe not every single broker has that exact policy of never calling, but the right to liquidate without notice, that's pretty standard in margin agreements. They need to protect their capital, especially if the market's going wild. They don't have to wait for you.
So relying on getting that call
Yeah.
is a really bad bet.
A very dangerous assumption, yeah. And it gets worse in terms of your control. Risk number 4. When they do decide to sell, you don't get to choose which positions they liquidate. Seriously. The broker decides they'll need to raise cash to get your equity back above the minimum, right? So they pick which stocks or assets to sell from your account, or accounts plural. Their decision is based on what's best for them, what's easiest to sell, what quickly covers the debt. It's not based on your long-term investment plan or your tax situation or which stock you really wanted to hold on to. Their priority is getting their loan repaid, period.
Man, the lack of control is kind of terrifying when you spell it out like that. Okay, what's risk 5? Feels like it can't get much worse.
But it can add another layer of unpredictability. Risk number 5 is that brokers can change their house maintenance margin requirements at any time.
Change the goalposts.
Pretty much. Remember, their house requirements are usually higher than the regulatory minimums anyway. A broker might decide, maybe because the stock seems riskier now or the whole market feels shaky, to just increase the equity percentage you need to maintain. And here's the kicker. They can often do this immediately, with no advance warning, no letter in the mail, no email saying, hey, starting next week. It can just happen.
And if that happens and suddenly you're below the new higher requirement,
Then you're instantly in a margin violation situation, even if the market didn't move an inch. And failure to meet that new higher requirement can trigger immediate forced liquidation, just like if your stocks had tanked.
wow. So you could be fined 1 minute and the next, just because the broker changed their internal rule, you're facing liquidation.
Exactly. It adds a whole other dimension of risk you don't directly control. And even if, in some rare case, a broker does decide to issue a formal margin call, maybe not following that IB policy we mentioned risk number 6 is, you're generally not entitled to any extension.
No extra time to find the money.
Nope. They can demand the funds immediately or by the end of the day or whatever short deadline they set. You don't have a right to say, can I have a few days? They can just proceed with liquidation if you don't meet their timeline, however short it is.
Okay. And the last one, risk 7, is maybe more obvious, but still important.
Yeah, the cost of borrowing. It's not free money. You are charged interest on the amount you borrow from the broker, the margin loan.
And that interest rate isn't fixed, is it?
Usually not. It typically fluctuates based on benchmark rates, like the broker call rate, plus whatever markup the broker adds. And of course, the more you borrow, the more interest you pay. These costs eat directly into any potential profits you make.
Right. Over time, especially if you hold margin positions for a while, those interest costs can really add up and make it much harder to come out ahead.
Definitely. So you put all 7 of those together, losing potentially more than you invested, forced sales of anything, possibly no warning, the broker picking what to sell, the rules changing underneath you, no extensions, plus paying interest. It really paints a picture, doesn't it? It's a powerful tool, yes, but wow, you need to be careful.
Extremely careful. And the source also mentioned a couple of specific situations, using margin in an IRA, for instance.
Yeah, the disclosure specifically called that out, said it might not be suitable for many people. Why? Because the stakes are higher. You're risking funds meant for your retirement. Losing more than your deposit in an IRA could be financially devastating in the long run. Needs extra careful thought about your goals and risk tolerance, generally seen as much riskier than using margin in a regular brokerage account.
Makes sense. And the other one was short selling.
Right. Short selling, betting a stock price will go down inherently, has to be done in a margin account. You're borrowing shares to sell them, hoping to buy them back cheaper later.
And the risk there.
The source highlights it clearly. Short selling has potentially unlimited risk. Think about it. If you buy a stock, the absolute worst that can happen is it goes to zero, right? You lose your initial investment. But if you short a stock, there's no theoretical ceiling on how high its price can go. If the stock you shorted just keeps rising and rising, you eventually have to buy it back to close your position. You could be forced to buy it back at a price many, many times higher than where you shorted it. Your potential loss is, theoretically, infinite.
That's sobering. And there are other costs with shorting, too.
Yes. You pay borrowing cost fees to the broker for arranging the loan of the shares you're shorting. And then there's the risk of a forced buy-in.
What's that?
See, the broker borrows those shares for you from somewhere else, maybe another institution, maybe another customer. The original owner of those shares can decide they want them back anytime. They can recall the shares. If that happens, and your broker can't quickly find other shares to borrow for you, they have to forcibly close your short position. They just go into the market and buy the shares back immediately to return them.
Regardless of the price.
Regardless of the price. Could be at a terrible time for you. And again, often with little or no notice, just like a margin liquidation. You're stuck with the bill for that buy-in no matter how high the price spiked, plus fees. So, shorting on margin. It stacks the already considerable risks as margin with the unique, potentially unlimited risk of being short.
Okay. It really sounds like once your equity starts to wobble, the control shifts almost entirely to the broker based on that contract you signed. Understanding these mechanics, like really understanding them from documents like that disclosure, feels like job one before even considering this stuff.
Absolutely. Ignorance isn't bliss here. It's just dangerous. These rules and risks are real.
Okay, so knowing all these, frankly, quite scary individual risks, it makes you wonder, why do we even have margin rules in the first place? Why did U.S. regulators step in? What were they trying to achieve?
That's a great question, and the analysis paper we have digs right into that history. It's actually pretty fascinating. The power to regulate margin lending in the U.S. stock market goes way back. It comes directly from the Securities Exchange Act of 1934.
The big one passed after the '29 crash.
Exactly. That crash and the Great Depression that followed were obviously huge traumatic events. And the thinking back then among policymakers was pretty clear. They believed that way too much easy credit, basically, easy margin borrowing, had fueled the speculative bubble before the crash.
So borrowing drove prices up unsustainably.
That was the dominant view. And they believed that when the market turned, the forced selling by these leveraged investors made the crash much, much worse. So the 1934 Act specifically gave the Federal Reserve Board, the Fed, the authority to set margin requirements.
The Fed, interesting. What exactly could they set?
They got the power to set the initial margin requirement. That's the minimum percentage of cash you have to put down when you first buy the stock. They could also set maintenance margin requirements, the minimum equity you have to keep in the account afterward. And rules for short sales, too, for stocks traded on exchanges. This authority led them to create Regulation T, or Reg T as everyone calls it.
Red T, heard that before. What does it do primarily?
Reg T basically tells brokers the maximum percentage of a stock's price they're allowed to lend to a customer. For decades, the initial margin requirement under Reg T for buying stocks was set at 50%.
Meaning you had to put up at least half the money yourself.
Correct. If you wanted $10,000 worth of stock, you needed $5,000 in cash or other eligible collateral, and the broker could lend you the other $5,000. This was a direct way to limit how much leverage an individual could take on right from the start.
So what were Congress's goals back in 34 when they gave the Fed this power? The analysis paper mentioned a few objectives, right? It wasn't just about protecting the little guy.
Right, there were broader goals. The paper outlines three main apparent objectives. First, they wanted to cut down on what they saw as excessive credit being used to buy stocks, just reduce the overall volume of borrowed money in the market.
Okay, curb speculation fuel.
Second, yes, protecting individual investors from getting in over their heads, from taking on too much leverage and risk. That was definitely part of it.
And the third one?
The third objective is the really interesting one, especially for our later discussion. Congress also seemed to believe that by setting margin policy, the Fed could actually reduce the volatility of stock prices, make the market less prone to wild swings.
Wow. Okay. Control volatility through margin rules. How did they think that would work?
It was tied to this economic theory that was very influential back then, something the paper calls the pyramiding to pyramiding theory.
Pyramiding to pyramiding. Sounds dramatic.
It kind of describes the supposed mechanism. The pyramiding part was the idea that in a rising market, when stocks went up, investors who were already using margin would see the value of their collateral increase.
As their stocks were worth more.
Exactly. And based on that increased collateral value, their brokers could lend them even more money. So they'd use this extra borrowing power to buy more stock, pushing prices up even further. It created this self-feeding loop. Rising prices allowed more borrowing, which fueled more buying, which pushed prices higher still. That's the pyramiding of leverage.
Okay, I see how that could inflate a bubble. So what's the depyramiding?
That's the flip side, when the market turns down. As stock prices start to fall, the value of the collateral held by these leveraged investors shrinks. Pretty soon, their equity drops below the maintenance margin level.
Triggering margin calls.
Triggering margin calls, exactly. And because these investors were stretched thin, they often couldn't meet the calls with fresh cash. So they were forced to sell stocks to raise money, or the broker sold for them.
And that forced selling pushes prices down even faster.
Precisely. This wave of forced selling the depyramiding would hit the market, adding intense selling pressure, making the price decline much worse and much faster than it otherwise might have been. It amplified the downturn.
So the theory was, control the pyramiding on the way up by limiting initial margin borrowing.
And you'd automatically reduce the forced depyramiding on the way down, leading to a more stable, less volatile market overall. Margin policy was seen as this direct tool to smooth out the boom-bust cycle in stocks.
That makes a lot of sense, especially looking back from the 1930s. So that was the original thinking. Have the regulations changed much since then?
The basic framework of Reg T is still there, but yes, there have been evolutions. The paper mentions the Fed's authority was extended to cover stock index futures in 1992. That was a big deal because futures markets were growing rapidly.
Right. Different products, same underlying idea of speculation or hedging.
Although, interestingly, the actual regulatory power over futures margins was then handed off to the CFTC, the Commodity Futures Trading Commission, just a year later in '93. And there are other related rules, too, like Reg U for banks, lending for stock purchases, Reg G for other lenders, Reg X, which applies to the borrowers themselves. It's a whole ecosystem of credit regulation around securities.
Now, you made a really important distinction earlier between margin for buying stocks under Reg T and margin for derivatives like futures. The paper really stresses this difference. Can you unpack that again? Why is it so critical?
It's absolutely fundamental to understanding the later debates, especially post-'87. Let's be clear. Reg T margin for buying regular stocks, it's fundamentally about setting the maximum loan value. How much can the broker lend you against the stock's price? You are literally borrowing money to help finance the purchase of that underlying share.
It's a loan, plain and simple.
It's a loan. Now, contrast that with margin in futures or options markets. The primary role of margin there is different. It's mainly a collateral requirement. Think of it as a good faith deposit or a performance bond.
Performance bond, meaning?
Meaning its main job is to ensure that both the buyer and the seller of a futures contract have enough money set aside with the clearinghouse, the intermediary, that guarantees the trade to cover any potential losses they might incur from one day to the next due to price movements.
So it's not really the clearinghouse lending money to buy the contract.
Not in the same way a broker lends under Reg T, no. The clearinghouse sits in the middle, guaranteeing the trade for both sides. The margin deposits protect the clearinghouse from one party defaulting if the market moves sharply against them. It ensures the integrity of the clearing system.
So it's about managing counterparty risk for the system itself.
Exactly. From an economic standpoint, futures margin isn't typically seen as credit extended by the clearinghouse. It's a guarantee from the participants. So while futures margin levels obviously affect how much leverage a trader can use, its core regulatory purpose is primarily prudential ensuring the financial safety of the clearing system rather than directly aiming to limit the amount of credit flowing into asset purchases, which is Reg T's main historical function.
Okay, that distinction is key. Reg T, limiting loan amount for purchase. Futures margin. Performance bond ensuring daily solvency.
You got it. Different primary functions, even though both relate to leverage. And understanding that is crucial when we look at what happened after the 1987 crash.
All right, let's go there. Because that crash, Black Monday, it really blew up the old consensus, didn't it? Despite decades of Reg T, the market still experienced this massive sudden plunge. And it reignited this huge debate about whether margin policy actually worked, especially concerning those stock index futures.
Definitely. Futures had become a huge part of the market landscape by '87, and they operated with much lower margin requirements than stocks under Reg T. A much smaller deposit controlled a large contract value.
So people naturally asked, did that lower margin, that higher leverage in futures, make the crash worse?
That was the central question. And it led to a flurry of official investigations and reports from the NYSE, the SEC, a presidential commission, the Brady Commission, and others. But here's the interesting thing. They didn't all agree.
Conflicting conclusions from the official bodies.
Yeah, somewhat. The analysis paper points out that the report from the NYSE, the Katzenbach report, and the SEC's own staff report seemed to lean towards the old way of thinking. They suggested that, yeah, maybe the lower margins and higher leverage available in futures did contribute to the problem. Maybe it fueled aggressive institutional strategies like portfolio insurance that exacerbated the selling pressure and increased volatility.
So they hinted that maybe futures margins should be more like stock margins.
They sort of implied that bringing the leverage in derivatives more in line with stocks might be a good idea, yeah. But then you had other influential reports, like the Brady Commissions. They focused more on the interconnectedness of the stock, options, and futures markets and stressed the need for consistent regulation across them, including margin. But they didn't explicitly say raise futures margins.
Okay, consistency, but not necessarily raising them. What about the President's Working Group?
Their report also looked at these cross-market issues. They basically concluded that margin levels in different markets needed to be adequate for prudential reasons, meaning high enough to protect the clearinghouses and brokers from defaults. But critically, they did not conclude that futures margins needed to be raised to match stock margins just for the sake of it.
Did they say anything about the volatility link?
They did, and this is important. The working group specifically noted that it might actually be appropriate for margins to differ between stocks and futures because the products and market structures are different. And they pointed out a lack of strong evidence that higher margins actually reduce volatility.
Wow. So an official group right after the crash was already questioning that core premise from 1934.
Yes, and they went even further. They mentioned evidence suggesting that making futures margins too high could actually hurt market liquidity, make it harder to trade, which could, paradoxically, make the market more volatile in some situations, not less.
So the official reports were kind of all over the place, some leaning towards higher derivative margins, others questioning the whole volatility link and worried about liquidity. That must have fueled a ton of academic research.
Oh, absolutely. The academic world dove into this debate with gusto, using more sophisticated tools and historical data to try and figure out the real relationship between margin and volatility. And one name that really stands out from that early post-crash research is Gikas Harduveli.
Harduvelis. What did he find?
He published a couple of very influential papers around 1988 and 1990. He looked back at historical data comparing changes in the Fed's Reg T initial margin requirement with measures of subsequent stock market volatility.
And his conclusion?
His results seemed, at first glance, to strongly support the original 1934 idea. He found a statistically significant negative correlation.
Negative correlation, meaning when Reg T margin requirements were higher, stock market volatility tended to be lower.
Exactly. He argued this wasn't just correlation, but causation. He even quantified it, claiming something like a 10 percentage point increase in the Reg T requirement could lead to an 8% drop in market volatility over the next month, maybe even more long-term.
That sounds like powerful evidence. Like, okay, margin rules do work to stabilize markets.
It certainly seemed that way, and his studies got a lot of attention, but this is where science gets interesting.
Yeah.
His findings were pretty quickly challenged by other academics.
Okay, who challenged him and why?
A major critique came in 1990 from David Shea and Merton Miller, Miller being a Nobel Prize winner in economics, so, a heavyweight. They didn't necessarily dispute that Hardy-Velez saw a correlation in his specific data set and time frame. What they disputed was his interpretation that it was causal, and they seriously questioned his methodology.
What was wrong with his methods, according to them?
They pointed out a couple of big potential problems. First, the way Hardy-Velez measured volatility using rolling standard deviations, and how he smoothed the margin requirement data using moving averages. Shane Miller argued that these specific statistical techniques could actually create the appearance of a correlation, even if one didn't truly exist in the underlying data. They called it inducing spurious correlations.
Spurious, like fake correlations caused by the math itself. Can you simplify that?
Yeah, think of it like this. Imagine you track, say, ice cream sales and drowning incidents over a year. Both tend to go up in the summer and down in the winter, so they look correlated. But ice cream doesn't cause drowning. There's a hidden factor. Hot weather.
Right.
Shea and Miller argued that the specific way Hardy-Velez smoothed his data over time could create a similar effect. It could make the volatility measure and the margin measure appear to move together statistically, purely as an artifact of the calculation method, not because of a real economic link.
Okay, so the smoothing might have created a phantom relationship. What was their other main point?
Their other major critique was about how Hardy-Velez set up his statistical model to test the depyramiding hypothesis. Remember, that theory says margin works by controlling the amount of credit. He and Miller argued that Hardy-Velez's model didn't properly isolate this effect. By including both the margin level, like 50%, and measures of the actual volume of margin debt in the same regression, it kind of muddied the waters and didn't cleanly test whether the margin level itself was the driving force behind volatility changes. They said his model was misspecified for testing that specific theory.
So bad statistical setup for the question he was trying to answer.
That was their argument. And the punchline. Shea and Miller reran the analysis. They used different ways to measure volatility that avoided the smoothing issues, and they tweaked the model setup to, in their view, better test the theory. And when they did that...
Let me guess. The relationship disappeared.
Poof. Gone. The statistically significant negative correlation between Reg T margin levels and volatility that Hardy-Velez had reported just vanished in their revised analysis. Their conclusion was a direct contradiction. No reliable evidence that Reg T levels control volatility.
Wow. That's a pretty major rebuttal. What happened to the academic world after that? Did other studies weigh in?
Yes, lots of them. And the analysis paper we're drawing on is pretty clear about the consensus that emerged. Over time, the vast majority of subsequent empirical studies using different data, different time periods, different methodologies, essentially backed up Shea and Miller's findings, not Hardy-Velez.
So the bulk of the evidence piled up against the idea that Reg T is a volatility dial.
That's the takeaway. The predominant finding in the academic literature since then is that there's really very little robust, consistent empirical support for the idea that changing Reg T margin requirements is an effective way to systematically manage or control overall stock market volatility. The link just doesn't seem to hold up reliably under scrutiny.
Okay, so that tackles the Reg T side. But what about the other big part of the debate, the derivatives? Did introducing futures and options markets, with their inherently higher leverage, make the underlying stock market more volatile? That was a big fear after '87.
Another critical question researchers tackled. Theoretically, you could argue it either way. Some economic models suggested, yes, more leverage availability via derivatives could increase volatility. Others suggested derivatives might improve market efficiency and price discovery, potentially reducing volatility or having complex effects. Theory alone didn't give a clear answer.
So they had to look at the real-world data again. What happened when these markets actually opened?
Exactly. The analysis paper summarizes findings from a bunch of studies that did just that. They looked at stock market behavior before and after the introduction of related derivative contracts, futures or options. People like Powers, Bessenbinder and Seguin, Kamara, Miller and Siegel did important work here.
And the verdict. Did introducing derivatives unleash volatility?
The overall conclusion is pretty striking and again, maybe runs counter to simple intuition. while launching derivative markets clearly did change things like boosting liquidity in the underlying cash market, changing who trades, and how much the studies generally found no substantial body of evidence that derivative introductions systematically increased cash market volatility.
No increase. Some studies even found the opposite, didn't they?
Some did, yeah. For instance, that Besson-Biner and Seguin study on stock index futures found something really interesting. They found that when the predictable part of futures trading volume went up, cash market volatility actually tended to go down.
Lower volatility with more futures trading. How does that work?
The thinking is that active futures trading might help the market discover the right price more quickly and efficiently. It provides another venue for hedging and information flow, which could actually help stabilize the underlying cash market, especially during normal times, perhaps by improving liquidity.
So rather than just being a leverage amplifier causing chaos, derivatives might have other more complex effects, some possibly stabilizing.
That's what a lot of the evidence seems to suggest. The simple story of more leverage via derivatives equals more volatility doesn't seem to capture the full picture. Okay, so one last piece of the puzzle. What about studies looking specifically at changes in futures margin requirements themselves?
Yeah.
Not Reg T, but the margins set by the futures exchanges or clearinghouses.
Right, the ones that act more like performance bonds.
Exactly. Remember, their main job is prudential protecting the clearinghouse. So researchers looked at when futures exchanges change their margin levels, does that affect volatility?
What did they find there? Different from Reg T.
Yes, a different dynamic emerged, consistent with that prudential role. Studies by people like Fish, Moser, Hardy-Velez again, this time with Kim, Day and Lewis, they generally found that causality runs the other way in futures markets.
The other way, meaning?
Meaning that changes in market volatility or expected future volatility tend to happen first, and then the clearinghouses react by changing margin requirements.
So the clearinghouses see things getting choppy, or they predict turbulence ahead, and then they raise margins as a safety measure.
Exactly. It's risk management in action. They increase the collateral required because risk has gone up. It's a response to volatility.
But does that response, raising margins, then successfully dampen the volatility afterward?
That's the crucial question, and the studies largely say, no, not reliably. The margin increase is a reaction to volatility, but it doesn't seem to systematically cause volatility to then decrease. For example, that Hardy-Velez and Kim study looked at metals futures. They found higher margins did tend to reduce trading activity, lower volume, fewer open contracts, but they didn't find a significant impact on reducing price volatility itself. Day and Lewis found something similar in crude oil futures. Volatility changes came first, then margin changes. But the margin changes didn't consistently predict subsequent volatility changes.
So even in futures, where margins change more often, the evidence doesn't support using them as a tool to control volatility, only perhaps to manage default risk.
That seems to be the strong implication from the research. The historical pyramiding idea as a mechanism controllable by margin levels to manage market volatility just doesn't seem to have strong empirical backing, whether you're looking at Reg T or futures margin.
Okay, wow. Let's try and wrap our heads around all this. We started with the stark reality of individual margin risk, huge potential losses, forced sales, no control, high costs, very real, very personal danger.
Undeniable.
Then we saw margin rules were born in the U.S. after the '29 crash with explicit goals, curb credit, protect investors, and reduce market volatility based on that pyramiding theory.
Right, that was the intent.
But then the '87 crash triggered this huge reassessment.
Yeah.
Official reports conflicted. And then decades of academic research piled up, especially work by GEI and Meller and many others, which essentially dismantled the empirical case for Hardy-Velez's findings and, more broadly, cast serious doubt on the idea that changing margin requirements, Reg T or futures, is an effective, reliable way to control overall stock market volatility.
Yeah, that's a fair summary. The synthesis that comes out of the analysis paper, looking across all this research, is pretty clear. Margin rules do affect things. Reg T influences credit volume, futures margins affect trading activity, but those effects just don't seem to reliably translate into controlling the ups and downs of the whole market's price level.
It's fascinating how the hard evidence gathered over time just doesn't seem to support that original regulatory goal concerning volatility. The paper even concludes there's basically no scientific basis for using margin rules as a volatility control tool. Strong words.
It reflects the consistent lack of robust evidence found by researchers looking for that causal link. It suggests that while margin impact individual leverage and maybe trading behavior, the big swings in the market are likely driven by other, more powerful forces.
Which brings us right back to the start in a way.
Yeah.
Because even if the academics and the data say margin levels aren't the master dial for market volatility,
The risks for you, the individual using margin, they haven't gone away. They are still absolutely real and potentially devastating.
exactly. The debate about macro volatility control is complex, and the evidence seems weak according to these sources. But the micro risks, the chance of getting wiped out by a margin call you can't meet, by forced liquidation at the worst possible time, that's concrete. That's in the fine print of the agreement you sign.
Absolutely. The academic debate might question the systemic impact, but it doesn't change the personal danger of leverage one bit. Those risks laid out in the broker disclosures, they are 100% relevant to anyone considering margin.
So maybe the provocative thought to leave you with is this. If the evidence suggests margin rules are more about limiting credit volume and managing individual leverage risk and less about controlling overall market swings, what are the big drivers of market volatility?
That's the real question, isn't it? If margin isn't the main lever, what is? Economic shifts, big changes in investor psychology, huge institutional money flows, algorithmic trading dynamics, global shocks.
Understanding the limits of margin policy, based on this research, maybe frees you up to focus more on those other potentially much more significant factors when trying to navigate the market's ups and downs.
It gives you a more nuanced, evidence-based view. You see what margin is a tool for leverage with significant personal risk and what it isn't, according to the research, a proven dial for controlling market-wide volatility.
Well, this has been a really insightful deep dive. Taking a look at the leverage engine, the rules meant to govern it, and what the evidence says about its actual impact. Hopefully unpacking the risks, the history, and the research helps you approach margin and the market overall with a bit more clarity.
Definitely a complex topic, but seeing the different pieces, the individual risks, the regulatory history, the academic findings really helps build a more complete picture. Thanks for digging into it with me.